Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Hey y'all, I'm feeling a little bit better thanks to Sudafed, thankfully. I had a terrible sinus headache yesterday afternoon and just was not in any shape to do any recordings. But today I've got a lot of stuff to do, a lot of stuff to catch up on, and the OU Texas game is today. Aside from that though, I did come across some interesting economic news that will play out in the stock market, and I do think wants to set the table for what we could expect over the next 12 months or so. So here's the thing. The Bureau of Economic Analysis, BEA, came out on September 30th and put out a report saying that Americans have spent up $630 billion of their savings. Now, this is a big deal because we, as a people, as Americans, saved up to $2.1 trillion as a result of the pandemic. This is extra savings, cash people were saving from a stimulus check, cash people were saving from not driving, not traveling, not doing all those things since 2020. That has been one of the main reasons we saw inflation the way it was, because, myself included, I saved enough. I'm like, oh, let me buy a house. Oh, let me go buy a car. And I had the extra money to perhaps overbid on certain things. Like I paid, it's a 2008 car, I paid in cash for that car, and it was like close to like 9 or 10,000. Had there not been a shortage in cars, perhaps that car would have been like 7,000 I could have saved. But I had the money. I had been saving. I wasn't spending money on daycare for 2 kids because daycares were closed. I had a whole lot of money to spend there. So what we're seeing that now is that about 30% of that has been spent up due to inflation and due to higher prices. At some point, that savings is going to dwindle back down to a normal level, and that's when you're going to stop seeing the significant spending and the significant inflation as a part of interest rates and a part of everything else. So we're a third of the way there if you want to take that measure and look at it that way. The other part is this. Target and Walmart have also responded, and they've already started a lot of their holiday sales in October. Now for me, that's annoying. I am someone who likes to respect the holidays in order. I don't like starting my Christmas season or Christmas music until after Thanksgiving. And that's just me. That's just me. Okay? It's not even Halloween yet, and people are already moving to Christmas, New Year's, sales and stuff. But the important thing is this. Because Target and Walmart have already recognized this, they are saying, look, we're going to extend these sales so that you don't have to spend all that money at once, and they want to divide these purchases up, which is smart. It's also what a company would do to extract as much money as possible, but it is something that people are paying attention to. So that savings, one of the main reasons as to why we saw inflation the way it was, not necessarily the supply chain, we don't really have an impact on that, but that is starting to dwindle down. We're a third of the way there in terms of spending up the savings that so many people were able to build up and save, which is a good thing. You want people to save, you want people to have the extra cushion, but because of these higher prices, groceries, cars, electric, gas starting to go back up and all those other things, it is starting to dwindle down a little bit. Now, what does this mean for you as an investor? One, there is, I don't really love to say this, but there is an end in sight for inflation, which we already knew. But I think now, the peak of this, the peak savings rate was, I think, August. It was in 2021. It was August or January 2021. I'll refer back to this article, and I'll put the screenshot there and probably put the article in the description below. But in either case, it peaked around, I want to say it was August of 2021. So it's a year and some change now, and that's a third of the way there. So if you want to kind of extrapolate that out, everything is starting to line up, because I also said in 2023, which is next year, that the Fed is going to continue to raise interest rates, and we're not going to see an interest rate cut or just a freeze, if you will, until 2024. That does track out. And that does not mean automatically that the stock market is also going to fall in 2023 and 2024. That's not a foregone conclusion. There have been many years where rates have been up and the stock market has also been up, but it does say that there is an end in sight, that these things will start to slow down at some point. I don't think it's going to happen before the end of the year. What does that mean for you? Just continue investing. This is just to give you just context of what's going on out there, and that there are going to be some stocks that are going to continue to slide. But I think at this point in the year, in October, I think we got a decent playbook on what has been working and what has not been working. And it's really those IPO stocks are going to continue not to do well. Other, I would say, consumer brands that have benefited from people having this extra money, those are going to be the ones to start to struggle. And the other thing that you want to pay attention to is cars, used cars specifically. New cars are starting to come back on the market, and that is something that could have an impact on the used car market. And that is one of the things that people pay attention to where inflation is going and how consumer spending is shaking out. So I don't currently have anything to do, or I don't have any stocks rather that have to do with the used cars or new car market, except I do own Ford. So you do want to pay attention there. Even Rivian came out and said they delivered more cars, I believe, than they expected. Tesla had some interesting numbers that came out last week. So pay attention there if you're concerned or you are curious about where the market, where the economy is going and how people are looking at those major purchases. Because the car market does tell you a lot. We saw in 2020 and 2021 that the used car market was the number one thing that rose in price like 300 or 400%, and lo and behold, we found out that inflation was high across the board. So do pay attention to that if you're looking to have somewhat of an economic indicator of what is to happen. For the rest of this year, I would expect a lot of the same. I would love for the stock market to be higher, and that just be the thing that we experience the rest of this year, but I'm not necessarily confident in it. For me, y'all know what the deal is. It's continuously dollar cost averaging, which has benefited me in many ways, and many of y'all as well. And then we'll see what happens in December when I take a look and make some changes in my portfolio. If you are new to the channel and you're looking for a place to invest, then feel free to go back and refer to our previous videos, particularly over the last like 3 or 4 weeks, because we covered healthcare, we covered some consumer goods like Hershey and others that have done quite well if you're looking for a place to invest. We also do deep dive breakdowns on some companies like Enphase that somehow have been up more than 100% from the time that we covered it. So if you are looking for some amazing companies that not a lot of people are talking about, feel free to check that out inside the members only. I will be recording a separate video for our members only. It'll be posted either today or on Sunday. All right, that is it for me. I've got a lot of football and barbecue, and I have to cut the yard. I'm gonna do that at some point today. I'm gonna fit it in at some point, but make sure you check out the members only. If you have any questions, comments, thoughts, or just reactions, feel free to let me know in the comments below. All right, that's it for me. I'll talk to you later. Bye.